One minute, the market is breaking records. The next it can implode at any moment. Markets were particularly volatile in 2022 due to fears about rising inflation and interest rates. In June, markets fell further as inflation hit a 40-year high. After temporarily falling into a bear market on May 20th, the S&P 500 slid back into one on June 13th. Although we may learn from experience how long crashes, stock market corrections, and bear markets normally persist, no one receives a calendar that predicts the time, nature, and likely magnitude of future falls. But what exactly is a stock market crash? Although there is no number that indicates a crash, here is some background information. On any given day, the S&P 500 stock index will fluctuate between -1 and 1%. Anything outside of these limitations may be called a stock market busy day, for better or worse. If the S&P 500 falls 7% in a single day, trade may be paused for 20 minutes. This has only happened a few times in the market's history, and it represents a really awful day on Wall Street. A crash is defined as a dramatic and unexpected collapse in stock values, which generally occurs after a stock market rise, often known as a bull market. Even if the stock market has its ups and downs, stock market collapses are not all that often. Among the largest stock market collapses in the United States throughout the last century are 1929. The stock market plummeted as a result of a weakening economy and investor fear, ushering in the Great Depression. The market bottomed out in 1932, more than 80% below peak prices, then recovered almost 2 decades later. The next one, 1987. On Black Monday, the market fell 25% in reaction to a market drop, investor fear, and early computerized trading gone wrong. The market, however, rebounded within 2 years, and the Securities and Exchange Commission instituted trading limits and circuit breakers to avoid panic sell-offs. The next one was in the year 2000. The dot-com bubble burst in March 2000, following a boom of investment and speculation in internet-related enterprises during the 1990s. The S&P 500 fell over 50% and took 7 years to recover. The next one was in year 2008. The S&P 500 lost over half its value as a result of the housing bubble and subprime mortgage crisis, and it took 2 years to recover. Here is a 5-step game plan for what to do when the market crashes. First one, understand what you own and why. A fear-based reaction to a transitory downturn is not a valid basis to sell an investment. However, if you review your initial stock research notes, you may find some compelling reasons to sell. Thorough stock research entails keeping a written record of the strengths, flaws, and purpose of each investment in your portfolio, as well as the factors that would cause each investment to be placed in the out box. Your research is like a roadmap for investing, a physical reminder of what makes a stock worth owning. During a market downturn, this paper can keep you from throwing away perfectly fine long-term investment just because it had a terrible day, and on the other hand, it gives compelling reasons to sell a stock. Before investing in stocks, you should have determined your risk tolerance, or how much volatility you are ready to tolerate in exchange for larger potential rewards. Investing in the stock market is always dangerous, but what makes for good long-term returns is the capacity to ride out the bad times and stay involved for the inevitable rebound. which is always on the horizon historically. It's fine if you neglected this phase and are only now questioning how well your investments match your temperament. Measuring your real reactions during market turbulence will give you useful data in the future. Just bear in mind that your response may be skewed based on the most recent market action. The second point, have faith in variety. When the market falls, your outcomes may differ and may be for the better. If you have spread your money among multiple asset types such as stocks and bonds. Diversification or spreading your money among investments is critical for lowering investment risk and smoothing the ride during a volatile market. Diversification ensures that your assets are not too concentrated in a single asset category. As a result, if one stock or industry has a terrible day, your other assets may be able to compensate for the losses. 3. Be prepared to purchase the dip. Dips in the market might sometimes be a good time to purchase. Consider buying equities on the cheap when the market drops. The idea is to be prepared for the downturn and eager to put money down to buy investments whose prices are falling. Here's how to know if you are ready to buy the dip. You already have an emergency fund, have set aside money for retirement, and have cash on hand for day-to-day costs. You have saved some money for a quick sell if calamity hits, and you have a running wish list of particular equities you want to acquire. If you buy the dip, you won't get the stock at its lowest, which is okay. The idea is to be opportunistic about assets that you believe have high long-term potential. Don't be startled if you freeze in place at the perfect moment. To combat the concern of bad timing, one technique is to dollar cost average your way into the investment. Dollar cost averaging smooths out your purchase price over time and puts your money to work when other investors are sitting on the sidelines. 4. Seek another opinion. When the stock market is on a roll and your portfolio is increasing in value, being an investor is delightful. When circumstances are tough, self-doubt and ill-advised strategies may take hold. Even the most self-assured saver investor might fall to dangerous short-term thinking. Don't allow your financial goals to be derailed by self-doubt. Consider hiring a financial advisor to go through your portfolio and offer an unbiased opinion on your financial strategy. 5. Think about the long term. When the stock market falls, it can be frustrating to see the value of your wealth dwindle while doing nothing. It can be especially difficult to see your portfolio decline during a year in which you may have become ill, bereaved, lost or changed employment. It's natural to be gloomy following a crisis, but when it comes to long-term investing, doing nothing is frequently the best option. That's it for today. Thanks for watching. See ya.